right, have a seat, please. Michael? Michael Speck, can you come join me? And Jim? All right, at least it's not raining cats and dogs. We just had a great morning session. It is humid, though. Okay. So there's some new people, new for us, community-wise, and I just wanted to rewind and whether you've been to 361 events or 200, and there are some that have been to 450. We do a lot of Zooms, believe it or not. So I want to actually just, on the screen here, it doesn't work when I want it to, but I'll touch the screen, and it works. So you'll see we meet Tuesdays for a briefing. So tomorrow, we'll have a briefing here. Actually, Kevin, where's the view? Most likely? Over there? Well, you'll see it on Zoom, right? And after these briefings, we tend to have a deep dive. A deep dive can be on any of these subjects. We talked about China's economy, right? We had Armin's on. We talked about the Tetris, the movie, because our community touched Tetris in so many ways. But whatever it is, we talked about space today. We have these events on Tuesdays or Wednesdays in these deep dives. How do we pick these topics? We do town halls. We'll do a town hall at the end of this after the breakouts. So it's getting the community feedback, and that feeds us and guides us to what we want to be doing. It guided me to Newport last year. So that's really listening to the universe. You'll see coming up, we're really slowing down. You're going to see a lot of re-architecting of 361 firm over the next month or two. Some really amazing things we're about to do. And just on but the big pictures will be in Europe, will be in all the way to, from Riyadh to Dubai, starting next year. Naples again. We couldn't play pickleball today. We'll play a lot of pickleball in Naples, as you'll learn. And Singapore, actually Armin, who's on with us, we'll talk about one of his signature events that he's putting together with the Prime Minister of Singapore. So I'll make sure you touch on that, Armin. But what is it that we do? And we're not just here for family offices. We're here because the families want deal flow, but they also need talent and they need partners. And they need to listen to institutional investors. And Todd is unique because he straddles both worlds, and that's a unique perspective that you can have. But a lot of families don't have that, right? They don't have the benefit of being on the NCI endowment committees, you saw the whole, as T. Rowe Price exactly saw that whole world as it is. But there's a lot that we can learn from each other. But what are we trying to do? We're trying to invest smarter, raise capital as you need it, connect to partners and people, and globally. So with that note, the 361 firm, the one firm is Arthur Anderson, where Michael and I were partners, and we're bringing the bands back together. So you want to give your global perspective or your Michael perspective?
Yeah, thank you, Mark. As Mark said, we will change, or we will add a lot of things, not change. We will take the good things Mark has done in the last 5 to 8 years here in the US. We will do this also in Europe. We started to establish the monthly lunch meetings with our team there. So it's running. So we have a great place, which is sponsored by one of our network members. He runs a wine fund, which is also specialized. But what we like to do is also to extend it to, and Mark has shown that, to Asia Pacific and also to the Middle East, as we believe that the collaboration on the worldwide base is much more efficient to get ideas from other areas, but also offer the opportunity to invest in other areas. So we are sourcing transactions worldwide. We are doing something. Todd is a very good example. Antler, I believe in that. This is a great group which is based in Singapore, which is doing great things in the States, but also in London. And we like to do the same thing, and we like to bring a little bit more of the world to the attention of the group here. That's what we are for. We're traveling around. We try to connect them this. And what we like to do is that we interconnect with each other, and that we also try to figure out different types of transactions which are unique and which are designed for this group of people. Not everybody has the same kind of interest, but we like to see that we have the brightest and best kind of transactions in the world, which we show you. And this is also something which is coming new. We will submit the ideas we will have on a database, which we will get access to. At the moment, our database has been stopped to be launched, but in September, October, we will be ready that everybody can swipe and say fit, fit not, fit, fit not. So this is a principle also on transactions. It's coming up, and we're working hard on that to make it happen. And this is something I like to hand over to Jim, because he's running this part more than I do.
Thank you, Michael and Mark. I think everybody's probably heard the expression, your network is your net worth. There's no place that's more true than 361. And if you see some of the diagrams that we have that explain our model, most of them are circular in nature. Why? Because we believe that connecting people is the way to get to better transaction opportunity. And we will spend a lot of time communicating that over the next few months about how we're moving more directly towards that intentional curation and intentional connecting of people in our community, which underlies pretty much everything we do, and our networks. So I'll keep it very brief, but great to see everybody, and welcome. Thanks, guys. Yeah, I don't know where Cenifer is, but yeah, we totally believe in, if you have a round table, you get all the views shared, you make smarter decisions. So with that, to kick off, we always have a Zeitgeist panel. It's a big picture, where the world is going. So we've got three people. Armin is going to weigh in last. He was just recently the president of Armenia, but he is also was the ambassador to the UK off and on for 20 years, and has a unique perspective there. He's just written 2 books, one of which is about the importance of small states, and he'll touch on that and some geopolitical themes. And you've heard from Todd. Todd's going to expound a bit more, but our anchor man, Stephen Burke, is going to kick us off. Todd, if you want to come up, you can. And I'm going to first put on your slides, Stephen. Yeah. That was probably me. So let me put on your slides.
I got it, Mark. Did you let me share?
Oh, yeah. I love it. You're trained.
Yes.
Remember our first Zooms?
Yes. Hand puppets.
We had to figure that out.
So thanks. I'm going to try and get through this quickly so we can get to Todd and Armin, because I think that's what I want to hear. So the title is Rates, Rains, Rockets, and Rainbows. And jump right into it. These are the forces, in our view, that are driving capital flows. And everyone, interest rates and inflation has been on everyone's mind, but it's leading to a significant revaluation of assets, and the decarbonization process and the climate change issue is proving challenging, but full of opportunities. How do we balance the two off? That's one of the things. The war has changed everything in our view, and I think it's going to continue to change everything for some time. And then the rainbows comes from a comment from one of the Chinese ambassadors, or one of the senior Chinese people that Janet Yellen met with. He said he hopes the storms of the past are behind us. We're moving through more of a rainbow period. I think we're going to see how that plays out.
Excuse me, can you turn off your video? We're getting a nice view of this.
Oh, sorry. Thank you. With my name tag on backwards.
You're still getting it.
I'm getting there.
Okay.
You got it now, Mark? Okay, so let's start with rates and inflation. And we have a multi-speed global economy, and I think one of the hardest things in this environment is determining where people are going and which stage they're in. And you have the developed world really in a rate increase mode. You have China and a lot of the emerging economies starting to cut rates already. It just shows you how different the world is. And one of the things that we have to be careful about is using what we want to have happen as opposed to what we expect to have happen and confusing the two. It's one of the hardest things about investing is when you have a portfolio, you want it to work, the world is not as easy with that. I think this move in rates and inflation and interest rates, the sharpness of the move has really pushed the global economy into a different stage. When you think for about 15 years, we've had near zero interest rates. Now we're up 300 to 500 basis points around the world. Just take Germany going from negative rates to 3% rates. The US on the 2-year going from one basis point to 500 basis points in a 12-month period. That adjustment process is a very difficult one to work through. We're still working through that, but I think in the US's case, rates are getting close to the end, which is going to give us firmer footing. But I think Europe and the UK are in a different spot, and I think they have some, maybe a difficult challenge ahead of them. I think when we get to the climate area, I think what's really interesting is not that the fact that we're in a climate change period that everyone is involved in and great opportunities, it's the challenges of it and the lack of planning that got us in a spot where it's going to take longer to get accomplished and might be much more expensive. And just to give you a sense, this shows the queues on the projects going into the queue for clean energy, and this is the U.S. look only. But what we're finding, and it's the U.S. and elsewhere around the world, is the grid is not ready for all the change we're trying to make, and the delays once you have a project permitted and ready to go to access the grid could be anywhere from 5 to 17 years right now. So this is a climate transition that's not going to happen quickly. It's going to create some big opportunities to make money, but when you have things going on that long, it's going to also create some big losses too. So it's one of the areas we really have to be thoughtful about. And this is one of those where proper prior planning would have prevented poor performance, but we haven't done that yet. And I think this is a big area, and you're starting to see policies to drive this, but the policies don't necessarily match the reality. So we have permitting that's slow in the US, we have getting access to the grid slow, but everyone wants to get to clean energy faster. We have to change that mindset. The rockets and the war in Ukraine has really developed a view that who thought we would have had war in Europe again, the way we're having it right now, but it's changing how you think about national security. It's changing how you think about food, energy, and technology, and who controls that, and how you work in a global economy that's shifting dramatically right now. And I think that what we really should be thinking about is not necessarily how does the war end, that's obviously important, but what are the fallout effects from that? And you're already seeing it with the Inflation Reduction Act and other areas where it's shifting capital at a very dramatic rate in a way that is permanent changes that are going on, or semi-permanent changes that are going on. You're not going to reverse this once the war is over. You can't reindustrialize. You can't change supply chains and expect that something's going to happen very quickly. When you have these kind of challenges, you're going to reverse it back. So I think you have to be prepared for a permanent change here. But I think maybe the biggest challenge for the world right now, aside from all the other ones, is what happens to the U.S. and China relationship, and how do the two leading economies decide to work together or oppose to each other, or elements of both to get there? And do we de-risk, decouple, or diversify? And that's a big problem for corporate executives right now. So it's going to drive the behavior of these two nations is driving capital flows around the world in a way we haven't thought about before. So at ARS, the way we're looking at it, where do you want to invest in this environment? You want to invest, obviously, in national security, because that's the paramount for every nation right now. You want to invest in both sides of clean energy transition if it's going to take longer, because as we're finding in the U.S. And in Europe right now, the U.S. having energy independence puts them in a very unique spot relative to countries like Germany that were so locked into Russian supply that it's starting to change the basis of manufacturing in a significant way. And you could see a reversal for the U.S. of the manufacturing decline. We think we're seeing it very rapidly. And what's happened is with the IRA, companies have jumped on it in a very material way. And already we've seen over $470 billion of new projects started in the US around this. And that's from the private sector jumping on what the public sector's giving it. So I think we're in a very different world than we've been in before. These changes are going to be not quarterly changes, but these are going to be with us for a while. And it's going to change the way we have to think about investing and how we've thought about investing for the last 20 years. So I'm going to stop there and get Todd up to talk about his view of the world and shift into how he sees that playing into venture, and then we'll get to Armin.
Thank you. Let me start out where you left off about global politics. I would say that the aura, the mystique, the magic of Putin was shaken not necessarily just by what's happened of late, but by the poor showing in Ukraine. And it's been magnified of late by the March for Justice that just took a referendum against Putin, where you didn't see people rallying in the street in support of the government. So from that standpoint, I think that Putin is in trouble. He still controls the mechanism that gives him power, but by the same token, the aura is gone. And I would say that you could say the same thing for President Xi as well, following on what happened in COVID. So it's interesting. There's so much concern about Russia and China, but there's some fracking there. You know, authoritarian regimes exist when everyone is afraid to challenge them. And I think there is some degree of uprising to provide some challenge. So, Mark also asked me to talk about looking at the world globally. You know, what are areas that I find of interest? I'm going to talk to you about venture capital, which to me is at the top of my list. Early stage venture capital is at the top of my list. But I think there is going to be a deleveraging tsunami in the U.S. credit markets. I think the opportunity is greater in the lower end of the credit markets because there's not as much competition there. I also look at things less from a macro standpoint, but more from a micro, because I'm looking at individual companies. And there's a company I'm involved with out of Canada and Switzerland called LODE, L-O-D-E, where we are tokenizing gold and silver. I think that's a great contrast to what's going on with Bitcoin. It's another company I'm very actively involved with that's dual headquartered in London and in California and LA. It's artificial intelligence aimed at the film industry. If you make a film in language A and you want to distribute that film in languages B, C, D, and E, the amount of money that you can generate for that plummets because dubbing sucks and people don't like subtitles. And this technology eliminates all that. I think it's going to be fascinating to watch. Anyway, let me get on to many of you were here this morning, and so I didn't get to finish. So I'm gonna go through this presentation from this morning. Which one? Okay, this just looks at the black lines are the amount of IPO and M&A distributions, liquidity events to LPs over time, and in 2020 and 21 combined, there was over $1 trillion of distributions, $1 trillion of liquidity events, which is why you saw continued increase in venture capital funding in 2022, despite the fact that interest rates were rising, inflation was rising, markets were going down, but people want some place to put their money. But from a liquidity standpoint, you can see that it fell off the map. So we had over $1 trillion of distributions in 2020 and 2021. And in 2022, we had $71 billion, a 91% decline. And I think this is going to stay low for a while. Why is that? Most activity is not IPO, it's M&A. And corporations, with trying to demonstrate to their shareholders that they're supporting their company, they're using their cash to buy back stock. They also are a little bit nervous about making an acquisition on the precipice of a potential recession. So the M&A activity is not there. And to get the IPO market back in place, you're going to have companies that are considered to be more profitable. This growth at all costs and lack of profitability, the public marketplace has lost interest in that. So it's going to take some time for businesses to change their business models to try and demonstrate more profitability. Okay, so valuations. The valuation compression, this is looking between the fourth quarter of 2021 and the end of the first quarter. I don't have all the data yet for the second quarter, so I just left it at the first quarter. But the valuation compression, as you see on this chart, was greater at the Series D stage, down 62% from pre-money valuation of $710 million down to $270 million. And it's interesting to think that when looking at venture capital, typically people think that later stage is less risky because you're closer to a liquidity event. But what's happened of late is that there is no liquidity event because the market is shut. So these organizations are stuck out there and nobody's putting net new money to work because there's no agreement between buy and sell on what the prices are. And so what used to be considered the most conservative area of venture has become the riskiest area of venture. You look on here, declines across the board except for early stage. And I'd say that some of that is due to the hype of AI in the early stage. But as you'll see from some of my comments here, I think that's the best place to invest. This is just, you don't need to look at the numbers. You can just see the lines coming back. This is healthy. You're getting valuations that are coming from the absolute ridiculous now back to something rational, both in the later stage and the early stage. So what are the implications of these valuation declines? Well, mega growth rounds have dried up. The mega growth rounds are organizations like sovereign wealth funds or my old shop T. Rowe Price, where they're putting in big amounts of money later stage. That's just driven up. And the tourist investors are leaving in droves. Portfolio companies are having to shift from growth at all costs mentality. So the era of blitzkrieging that Reid Hoffman talked about, I think that's over. And companies are focusing more on unit economics and profitability, which is a healthy thing to have. There are a lot of actions being taken by companies and by VCs to extend the runway of the cash that they have. And more VCs are spending more time on their existing portfolio companies than they are in putting net new money to work. So there's a big upload of unspent cash, over $500 billion globally, but it's not being spent. And so it's starving some of these companies. So you're going to see flat rounds being the new up rounds, and you're going to see more down rounds. In the first quarter of this year, there was 20% of the deals that were done, they were down rounds. And I think you're going to see more of that. Secondary activity that was talked about earlier is going to be healthy. I think that's an interesting place to play. But as you'll see from my comments later, that I think pre-seed is the best place to play in this environment. And one of the reasons for that is that when you're in a period that's following an economic recession or some declines, it's a great time to start a company. And this is an example of that. So the red line is the upper quartile total value to paid in the venture industry, and the black is the S&P 500. And as you can see here on the left, in the time period of 1988 to 1992, venture outperformed the public markets, but not by a huge amount. But when you got to the period that was after the recessionary period, you could see that you had a TVPI of 4.6x versus 1.7 for the S&P 500. And then flipping over to the right, the same thing happened after the great financial crisis. In years 2010, 11, and 12, IRR, distributions to paid in, total value to paid in, multiple of investment capital were far superior across the board, and in the area that most superior was in the early stage. And so why is this? Why does this happen? One, a lot of talent is available inexpensively, and a lot of folks are leaving tech companies because their options are undervalued, underwater. So there's less angst or less cost or reluctance to leave a company and start up new. Also, because of the advances in technology, the cost to start a company is that much lower. And the entrepreneurs that are starting companies in these down periods recognize that they need to conserve cash, so they're a lot more disciplined. So it's an interesting time to start a company. I would say that looking out over the next couple of years, these are going to be very attractive vintages to have put money into the ground. Now let me talk to international. So my first part there, as I was saying, it's interesting to invest in venture in this time period. This bit is about international. What this looks at is the number of cities around the globe that had at least one unicorn. So back in 2013, there were 38 companies, 38 cities around the globe that had at least one unicorn, 18 in the United States and 20 outside the United States. Fast forward to 2021, there was 170 total. 128 of those were outside of the United States, 42% inside the United States. So the growth rate is dramatically higher outside of the United States. We all know about the PayPal mafia here in the United States, but there are PayPal mafias happening all over the globe, and it's going to continue. So by not investing some venture money outside of the United States, you're missing an opportunity. And this is another way of looking at it. This is just unicorns. The current active unicorn count in the United States as of the end of 2022 was 653 unicorns. Outside the United States, 553. In terms of the current active unicorn value, 2 billion inside the United States, 1.8 billion outside. So, close to 50-50. And so not having money invested internationally is potentially you're missing an opportunity. Now let's talk about the case for increased portfolio diversification. If there's one thing that we learned from the Silicon Valley Bank and Republic banking crisis is the importance of diversification. So is the venture capital asset class risky? Well, the way it's currently done, it is. I mean, certainly on a case-by-case basis, a company-by-company basis, it's very, very risky. And the power law is here and well. There are lots of strikeouts and a few home runs. But you look at portfolio theory, and true asset class risk is the risk that remains after you're diversifying a lot of that away. As currently practiced, the VC industry is not doing that. And why are they not doing that? Because they've got smaller portfolio sizes. So as I'll show on the next page, the wide dispersion between upper quartile and lower quartile is a function of lack of diversification. This is data from Cambridge Associates over a 20-year time period. And you can see the upper quartile, which is the triangle, and then the lower quartile. On the far right is for global equity, publicly traded global equity, and then the other two are private equity and venture capital. You can see the narrow focus in public equity. You might have major movements over a single day or a month or a year, but over a 20-year time period, the difference between upper and lower quartile is not that wide. But in venture capital, it's enormous. And one of the reasons it's enormous is because underlying venture capital funds are not properly diversified. So, was I not on that page? There you go. So the conventional VC model versus a more diversified approach. The conventional VC model relies upon the power law mathematics to rationalize overly concentrated portfolios. We all know that. I made the comment that researchers have found that more than 50% of venture deals go public. I heard from someone earlier that their data shows 90%. So let's say it's somewhere between 50 and 90%, but let's be conservative and say it's only 50%. Classic portfolio theory says that you need 50 to 70 stocks in a portfolio to give yourself appropriate diversification. So to arrive at a 50 to 70 stock venture capital portfolio, you have to have a portfolio of 100 to 140 companies, since 50% of them are failing. Well, very few venture capitalists have that much diversification. And a key reason for that is they don't have the requisite staff to be able to do that. That's not been part of the DNA. So this firm called Loyal VC did some Monte Carlo simulations, 2,000 Monte Carlo simulations of hypothetical returns looking at a 500 company portfolio and a 15 company portfolio. And what they found is that the 15 company portfolio had the volatility as measured by return dispersions, very similar to what I just showed you from Cambridge Associates for the industry. But the 15 stock portfolio, but the 500 company portfolio had returns that were very similar to that of the global equity public markets. So, and the median return was actually higher on the 500 company portfolio than the 15 company portfolio. So the conclusion here is that increasing portfolio diversification minimizes the volatility, it increases the return, and you can see it truncates the downside. So now I want to take you to a firm that I'm on the board of that has taken this concept to another layer. And the firm is called Antler. Antler was only started in 2018. It's headquartered in Singapore, but it's got offices all over the globe. They do not invest in companies. They invest in talent. They look for talent around the globe. They bring talent into anywhere from a 6 to 12-week internal program, and they match people together to create companies. Contrast that with like Tiger Global, they're doing analysis in less than 24 hours and pulling the trigger and making an investment. So once they're in this program, they're building the teams, they're validating the model, and if the Antler likes what they've constructed, after presenting to investment committee, they'll be the first check in at a very, very low valuation. So in essence, they're creating their own deal flow. They're not finding deal flow from the outside. And then they provide a lot of significant follow-on support. Antler's got over 600 advisors around the globe. They introduce the companies to the local VC communities. They introduce them to incremental talent. They introduce them to customers and suppliers. So in essence, it's a global enablement program. Oops. Why is this not moving? Can you help me, Mark? Okay, here we go. So Antler was only started in 2018. There are over 250 employees around the globe, and all of them are prior entrepreneurs or technologists. They're not bankers, these are operators. They've got these pre-seed funds all around the globe, smaller size funds, but just as I told you, that's the first money in. They've now created well in excess of 800 companies, and you can see that they're far more diversified in terms of gender and nationality, and they've won awards in terms of the robustness of their ESG and impact evaluation metrics. Oops, that control. I don't have control. All right, here we go. So everybody knows Y Combinator. Fantastic organization, great structure. Last year, Y Combinator had 20,000 applicants. That was up 20% from the prior year. And they accepted 282 companies into the Y Combinator program, which was an acceptance rate of 1.4%. All of these were existing companies that they invested in, and I have nothing but the highest regard for Y Combinator. I'm just mentioning it because because of the analogy to take a look at. Last year, there were over 80,000 people around the globe that applied to get into the Antler program. Thus far this year, based upon what we've seen in the first quarter, it's going to be in excess of 100,000. Of that 80,000, they brought into the program only 2,500, or 3%. Then they're mixing and matching these people together over the 6 to 12-week time period to come up with the creation of companies. And they had, call it typically, 2 people to a company. So 1,000 entrepreneurs came in. I mentioned that, okay, this is really interesting. Antler is the first money in. There's no competition because they've come through the Antler program. There's no other venture capitalist that's bidding to get into the deals. So prices do not go up. And Antler's program is contracted. So on the left-hand side is entry valuations in the United States, and on the right-hand side, entry valuations outside of the United States. And you can see on the black line, this is the market, you could see an increase from 2020 of $7 million to $10.2 million in 2022. Antler is basically flatlined because it's contractual. Same thing on the right-hand side. So it's built in alpha because they're in so inexpensively. Oh, there we go. Oh, go back one. So you know the firms on the right, Y Combinator, Entrepreneurs First, 500 Startups. These are all fantastic organizations, and they do a great job, but they're 1.5 years into the company's formation. Antler is back here at the start, and they've got people all around the globe helping these companies. So you've got built-in alpha from the start. So now let me take you to this interesting product, the Antler Global Access Fund. Antler didn't think of this. It came from our institutional and family office clients. Many of our clients were investing. They say, you know what, I really want to be into the Nordic Fund or the Southeast Asia Fund or the US Fund or the Canada Fund. But then they came back and they said, you know, I want exposure globally to the developing innovation all around the globe. How do I do that without having to fill out paperwork and KYC and having multiple capital calls and all these different funds? And so what Antler came up with was a fund of funds, a no-fee fund of funds, because all the underlying economics are in the Antler funds. And you get the broad diversification, you get the narrower return dispersion, you get truncated downside, attractive returns, and singular paperwork. It's like a one-stop shop for global early-stage evaluation. So 2 pages left. Oh, I'm sorry. I'm talking and I don't know what page we're on. Can you go back one, Mark? Okay, so, yeah, 30 seconds. So Antler did 6,000 randomly generated portfolios in a Monte Carlo simulation of possible returns using the return profile of over 1,000 seed stage deals between 2008 and 2018. So scrapping out the craziness that's happened over the last couple of years. And they did this Monte Carlo simulation, and they did it for portfolios of 75 companies to 1,500 companies. And what you discovered is in this table right here, the 75 company portfolio had a median return of 1.5x. But you go all the way out to the 1,500 portfolio, and it's 6.1x. Likewise, the bottom decile went from 0.4 all the way up to 3.5. So by virtue of pulling together a more diversified portfolio, you significantly increase the median return and you truncate the downside. So there's far more predictability in the venture portfolio. And so the conclusion page is that, you know, venture capital remains an attractive asset class. We're living in a golden age of technological innovation that's going to impact every industry. So the asset class makes sense. Pre-seed affords an entry valuation that's very, very attractive, including good returns. Starting a company amid a negative economic environment has proven to be prescient, and so too investing in those funds in those vintage years. There's a lot more opportunity globally. The power law nature necessitates increased diversification. And Antler is one of the few firms that's very well positioned to do that because they're all around the globe. So, thank you. Any questions? Fully understood. Okay, let me let you move on.
So, Armin, you've heard the macro picture. Todd also had some interesting comments about China and Russia. You obviously know geopolitics better than anybody in this room. What are your reflections on the way the world is today? You're still on mute.
Good boy.
Not yet. Don't turn me yet. Give me a second. You can log back in. We can't hear you. He's off mute. Everything. Hold on 1 second. Maybe you're on our side. One second, Armin. He's not muted. How do you access your volume? 1 second, Armin. Audio setting. Just give it a moment. It's the rain this morning. So, yes.
He's not muted, right?
No, he's not muted. If anyone, Jim, why don't you speak from your device? Make sure. You should. Speak from your device and see if it works. The volume. You can log in.
That's a microphone. Can you speak now?
Hello?
Yes,
Hello?
I hear you.
Can you hear me? So, do you hear me well or no?
Yes, perfect. Thank you. Sorry about that.
Perfect.
Yeah.
Fine. So how many minutes do I have, Mark?
How many do you want?
No, don't ask me that sort of questions. I told you. I used to be teaching at university, which is 2 times 45 minutes. Lecture.
How about 7 to 8? Can that work?
All right. Do you hear me well now?
Perfectly. Yeah. Maybe make it 10 because we took 2 minutes from you just now.
Hello?
We hear you.
Do you hear me?
Yes.
Yes?
Yes.
All right. Let me try. If you don't hear me, bad luck for me and for whoever will be interested. I really was trying hard because the connection was not good, the quality of the sound coming. But I saw the diagrams and I was guessing some words. What was quite an interesting discussion and presentation, so I learned some things there. Of course, I would like to have further questions from me to ask about the interest rate behavior in the future. But one thing is clear that globally in many countries, the rise of the interest rate is also connected with a lot of problems which are more political and social and connected with food security, health and so on and so forth, things that really matters in our life. And when I speak about food security, I also mean food, water security, climate, health, and so on and so forth. The higher the interest rates, the more difficult it will be to speak in the societies about the necessity of paying more and more attention on essentials. Then you spoke about the decarbonization, and I looked at the diagrams, which are basically exactly what one would expect one, because we have much more expectations what we want to do, and in reality what we can do and what we really do here. And of course, the one disturbing thing for me as a physicist who is a scientist is that unfortunately the nuclear power part of that, which is the red in your diagram, is not changing much. Despite the fact that we want to live in an absolutely green and yellow world, according to your diagram, but we still live a bit less in black, which is oil and coal, but more in gas, which is gray. So our path from the black and gray into the yellow and green definitely has to go through red. Because in long term, I think nuclear is a solution. Of course, there is a public opinion, there is a fear, but as a physicist, I can tell you that there is nothing wrong with the nuclear technology worldwide. All of the big crises that happen with the nuclear power plants are a result of the human error. Started from Chernobyl, when they were testing the nuclear power plant and giving access to their workers in order to do all funny things without the securities being on. This was Soviet Union. And going to great Japanese disaster, again, it's man-made one, because technologically there was nothing wrong. It was just the greedy of the ownership that instead of putting the nuclear power plant in the mainland, they put on the exactly near the ocean. And this is a country that is famous worldwide with non-standard behavior of ocean and also earthquakes in Japan. So I think a big mistake of the design. So what I'm trying to say that nuclear is an important solution and one has to take that into account. The war in Ukraine, unfortunate, but the question is how we are going to look at this war again. Because at the end of the day, we all know that every and each time when we're speaking about peace and a long peace, longer peace, and an area of time when the humanity globally and or in specific regions was developing very fast, very effective, this is between wars, and every and each big war is in some sense also a locomotive or generator of future economic competition, but in new circumstances. You say after every big war, there is regionally or globally a new political, geopolitical environment, and then the states have to adjust them, and the wars are terrible, are not human, they take millions of people's lives, but at the end of the day, then people have to come to their common sense and they have to start putting a lot of effort in development. So if I simplify and make it a bit vulgar, maybe that there are mainly two locomotives of development. One are the wars that are happening and the other one will be industrial revolutions. And when I look at this situation today, of course, we cannot call the war in Ukraine as Russians and Putin are calling them limited military activity or limited special operation. Because it's a huge war, it's a European war, and in fact it's a global war. And so that war is going to be the sort of after this war, and whenever it finishes, we cannot see that it's finishing yet, but although the parties are coming to maybe to a situation that defending becomes more important than attacking, at least for Russians for the moment, and Ukraine is trying to attack more, but sooner or later probably some negotiations will start, and I think we can think about what will happen after war. But the second component, it's very important, that second component is industrial revolution. I mean, you can speak about fourth industrial revolution. I have a theory that I presented a couple of years ago at the World Economic Forum, saying that there will be no more industrial revolutions, but will be facing is something that I call it our evolution. If you put together, you have a revolution. Basically, what I want to say is that starting from today and tomorrow, there'll be one after another revolution in biotechnology, in artificial intelligence, in digital, in energy, and we'll get closer to the controlled nuclear fusion and so on and so forth. So we'll be living at a time of a constant revolution. And there will be no industrial, there will be scientific, industrial. So we'll be living in an era of our evolution. So how the world will look like after the Ukrainian war, which has become a sort of a European and global war, and after the constant our evolution. In order to understand that, I will need just an hour and a half from you, Mark, next time when you invite me somewhere. Or number two, I invite you, all of you, to come to Singapore, where we're having our Advanced Tomorrow conference. And I'm doing probably that after 3 years, 4 years doing in Armenia. When I was president, now I'm doing in Singapore, together with the Singapore government and National University. And we'll be focusing on one specific thing, a big thing, which is called health and well-being. And we will have geopolitics and health, we'll have artificial intelligence and health, and we'll have space, and we'll have top guys from NASA and other space agencies. So many aspects of health. And one would say, what does health have to do with geopolitics? Of course it does. And we'll have not only top class professors of medical, but this is not a medical conference. It's about, of course, as is the geopolitical thing, because if you look at health as a big thing, you have health connected with food security, water security, climate, and you have one end of the health, which is the health of those who are poor, and with this current environment of international relations. I don't want to even touch Ukraine and how much that basket of food of Europe is not producing food, and people are suffering because of that, both in Africa and the high prices in Europe. I'll just take even the other aspect of that, which is sanctions against Russia or Russian individuals. One of the Russian companies, for example, is producing around 8% of global fertilizers. Because of the sanctions, that is not produced in the market. But as you know, in many places, food is in direct connection with fertilizers. So you are speaking about 8% of the fertilizers, probably you are speaking about 7-8% of food, and we are speaking about 7-8% of global population. That will be suffering. They will not die, but their health will die. So there is direct connection between food security, water security, and health security, and environmental security. So I'm happy to invite you to Singapore, all of you, and the 3rd to 6th of December. That will be at our partner will be National University of Singapore and also the government of Singapore, and it will be beautifully organized. It's around 300, 250 max participants, all invitations. And for Mark and for you and your team, we will waive, so it will be free for you. You don't have to pay for participation. But I would like some of your colleagues to come and contribute as speakers.
Thank you.
Now, do I have another 5 minutes, Mark?
You have 2 minutes.
Hello?
2.
Is it yes or no?
2 minutes. 2 minutes.
2 minutes, okay. Now, going back to venture, 2 words about the venturing. Of course, venturing is very, very close, in my understanding of world affairs, is very close related to something which is called predictability. And we are living in a new world which is quantum. And despite the fact that we had pandemics, despite the fact that we have the war and all of that stuff, but we all are moving into new era. So we are on the crossroads of the future world. And that future world, either there will be several scenarios of this world. Let me just uh, give you a teaser. In order to understand that, we have to look very bluntly to the world. In the world, for the moment, we have only one country that is a superpower militarily. That's the United States. That's obvious. There's only one country that can deploy army anywhere in the planet. Nobody comes close, neither China or Russia and so on and so on. Russia has the privilege, together with the United States, that if they put together their nuclear weapons, they can destroy this planet 6 times. Not once, but 6 times or more. So that's it. But militarily, there's only one superpower. Economically, pretty soon we will have probably 2. Soon means in upcoming years. And United States and China. And I think they have to negotiate with each other about how the future world will be looking like. So we will go from unpredictable world into more predictable new laws of behavior and so on and so forth. If we're lucky and they will agree. But then the world will become much more complicated because in this new world, which is quantum, with our evolution of technology, there is a third dimension of the global events or global behavior, and that dimension is technology, both biotechnologies and other, but specifically artificial intelligence. And with artificial intelligence, you will not have one superpower or 2 or 3. You will have many. And the whole thing will be much more complicated because who will become a country that will be able to contribute in this global debate will be smaller states, small states like Israel, like United Arab Emirates, small states that have the power and the money to develop artificial intelligence with the help of startups, a lot of talent. There is a flood of Russian talent now. Around 2 million young Russians have flooded Armenia, Georgia, Turkey, Istanbul, and Dubai, and so on and so forth. There will be other states as well, and that states will be unusual states. That will be international big technological companies that will start behaving like states. They will belong to a state. For example, Google, in my vocabulary, is a state. It's a virtual global state. And that virtual global state will have its say in the future of artificial intelligence. So basically, you will have competition in military, competition in economic, which is the classical one, and you will have a competition in new technologies and artificial intelligence, when you will have many players, including the small states and the sort of virtual states, which are the Microsofts and Googles and others. So God help us on the third dimension. I think we have to think and to do a lot in order to create the right environment so that negotiations on the third dimension also go smoothly. Otherwise, artificial intelligence and new biological technologies will be very, very, they are the God's blessing and also God's not blessing can become. So again, a lot of things. Thank you for the invitation, but I would like again to appeal to all of you. These are the things that we will also discuss in Singapore, and I'll be very happy to see some of you, and as many of you in Singapore, because I joined this 361 sort of a club, or with pleasure. I didn't know about that a couple of months ago, and thanks to Mark and Michael, I like it now, and I'll be very happy to see some of you there. Thank you very much.
Thank you, Armin. We're pushing it back by just a few minutes because we have to have at least one question. We talked about, the 4 R's. We talked about. You want to? Yeah, come on. Todd, you talked about. You actually talked about how Xi and Putin have sort of lost their veneer, their aura. You talked about a new, sort of, not quite a new world order, but after post-war, and then we have these AI scenarios. And by the way, I think you should have 361 people in Singapore if you could arrange for that. But any questions of these themes that we've talked about? Of course, Andrew. No, it's good. It's good.
Actually, Todd and Armin alluded to this. A lot of these startups, get going and they have good things, and quite frankly, if one of them just simply run out of money. So the more startups we have, and we have failures and all that. But if you take, is there an opportunity you think down the road where there's a subset of startups that have something good going, IP, whatever it may be, but simply run out of money as an opportunity?
We talked about that in London. People are buying turnarounds.
There will always be an opportunity for someone to opportunistically acquire a distressed asset. Putting a distressed asset portfolio together by trying to cherry pick all startups, that's a monumental task. And I think it would take a long time, so I think it would be difficult to implement. That would be my take.
Question for Armin. You spoke.
Hello?
Hello, my name is Mayor. You spoke a lot.
Mark, I'm here, but I didn't listen because your microphone is, I don't know.
Can you hear my voice right here?
I hear for yours very, very clearly now.
Yeah, you spoke. Yeah, so you spoke about nuclear energy. So my question is, what are your thoughts on fusion? Because a lot of people are saying that that is the magic solution to help decarbonize our economy. Your thoughts on fusion?
Well, I don't have those. I hope that we will get there. Theoretically, it's fusion. I mean, on the practical basis, technological reminds me the story connected with black holes. I am a theoretical physicist, and I did a lot of work in relativistic astrophysics. There were decades that we know that, but that from the theory of Albert Einstein, it comes out that they must be black holes. But we couldn't find them. We were trying hard. There's a difference, of course, between observational sciences like astronomy and experimental ones. But it's the same story. We knew that the black holes were there until we got some technological advances, and our telescopes and our measurement instruments helped us to detect the black holes. And that was one of the greatest discoveries that in the world. But for decades, people, based on the classical physics or quantum physics advances, we got that. Do you hear me, Mark?
Yes, Armin.
Mark?
Yes, Armin. We've run out of time, unfortunately. So
Yeah.
we know that you're coming to the U.S. and we're going to organize a
My
lunch.
conclusion is that theoretically we can get it soon, and if we get it, that will be phenomenal for the world. That's it.
So thank you, Armin. Thank you, Todd. Thank you, Stephen. We'll move on to the next panel. Thank you.
Thank you very much.
So our next, we want to talk about, with that stage set, is where should we be investing by asset classes? You've heard about venture. You've heard, we're going to talk about most of the public markets for a moment, set the macro again. And we've got our friends here. The reason we're here, we were on the rooftop last year, and you did Docktails. Well, let's merge Docktails with 361 from what we do. So here we are. So, Kevin, kick us off.
slide? You do. Okay, very good. Thanks. So, welcome, Kevin Jay, Discipline Alpha. I could see you all and see some familiar faces. So just for the next slide, talk a little bit about Discipline Alpha, but just a second. So we're doing long-short equity, but up front we use a macro regime model to determine whether we should be tilted to growth or value stocks. And most people in the industry, their whole career is in one of those two, from an equity standpoint, that is. We're not saying one is better than the other, but we're saying one is more likely to outperform the other for the next 2 to, say, 4-year time period. So we're based in Boston, but the next slide, the universal stocks we work in is the large cap Russell 1000, and then the regime model, right, second part down, tilts to both growth and value, as well as our gross and net exposure. So the next slide. There's 4 things we do that are unique, but what we're here today is talk about the regime part. So the first bullet point, the unique regime model that we have. And just so you know, so it's not so specific just for equities, you can also use this regime approach to asset classes as well. So we're in what we call risk on or momentum regime. You want to overweight equities, and when you're in risk off, you want to tilt more to fixed income, and within equities, you should have more of a value tilt to them. So on the next slide, so this is the beginning of about 5 slides on the regime model. This is just very high, saying at the top of the slide, things go in cycles like weather. It was rainy before, tomorrow it's going to be sunny, great boat day. Okay, the middle, more behavioral finance. So you could take greed on the left, fear, and then greed. So bubbles develop here on the left. Bubbles burst. You get things like denial. People's retirement statements come in the mail. They deny there's bad things in there. They don't open them and put it on the shelf. Okay, you go through these sort of 7 stages of greed from a behavioral standpoint, and then things get better again. From a factor or a way of ranking stocks perspective at the bottom, basically value matters initially. It's ignored at the peak. The bubble bursts. There's a junk rally, and then value matters again. So if you were to look just on the next slide at these 2 factors of value and momentum, the red line is going long short value, so going long the cheap stocks in red and shorting the expensive ones. Green, you're going long with stocks that have outperformed the momentum stocks and shorting the ones that have underperformed. So we all know in the late 90s it was all about the internet bubble, and green did very well. When that blew up, it was all about red. So most firms will not try to figure out when to time. They'll just see always growth managers or always value managers. So the next slide, when I started to look into this about 20 years ago, there we go. Okay, so these slides I actually built about 20 years ago, so I made them look old and you can hear in PowerPoint. But basically, these are just deciles of price per share. So after the internet bubble was a big run in the late 90s, internet bubble blew up, a low of 1 or 2. Then you have this big junk rally. So these are $1 and $2 stocks over here. They're up about 64%. The Russell Midcap at the time was up about 26. This is in the second and third quarter of 2003. And then looking at these low price stocks, breaking them into buckets of quality of earnings. So the lowest quality of earnings stocks over here, within the $1 and $2 decile of stocks, almost double in that same 2 quarters of the second and third quarter of 2003. So the idea was to basically try to understand what happened. Okay, very good. Perfect. So, so the idea was to try to come up with data that said, how do we model this shift from risk off for 3 years in a row and the market is down so much to risk on, where there's low price, low quality stocks double. So the next slide, what I looked at macro data that it's in the wheel of data on the left. Very few people try this. Thank you. Very few people try to build regime models. The ones that do often look at GDP to figure out if GDP is expanding. Okay, we're in one regime, GDP is contracting, we're in another regime. But the problem with that is GDP is quarterly, it's lagged, as we stated. So looking at this wheel of data like housing, it comes out monthly, it comes out pretty close to the end of the month, it's not really restated. And so that's a better predictor. And also it's forward-looking. It shows a willingness to take risks because people tend to build houses without a buyer. And so if 9 months later when they have they think there's a strong market, they'll build more houses. So when we're in risk on, when the macro data that we look at is bullish, people build more houses, then we're in momentum regime. And in that environment, we don't have very much tilt to value. There's only 10% of our weight in our model is tilted to value. When we're in momentum regime, we have a lot more tilted to this growth factor, which is estimate regime. When we're in value regime, there's a lot of uncertainty. When you talk to CEOs in momentum regime, oh, we're going to grow 20% forever into the future. 6 months later, we're in a recession, and they don't even want to give guidance about the next quarter. So when we're in these uncertain value times, then we overweight value factors, as you can tell by the name. So on the next slide, we're just really looking here at the regime index itself. So green basically means that those are the periods you want to tilt to momentum or growth stock, and pink was when you want to tilt to value and quality. Basically, when the market is running in between recessions, growth tends to do pretty well. When the economy is weak, when there's a lot of uncertainty, quality works on the way down and value off on the bottom. So the next slide is really just reproducing that signal to say what happened in the real market or real economy. And if you could, Jim, just shift one more slide ahead, you'll see this just overlaid with some annotations about, well, you built this 20 years ago, it was in risk on, up until the financial crisis when it went to risk off, 2 months ahead of Bear Stearns blowing up. And then we launched the firm in 2013, it was growth, up until a slowing China, went to value, went back to this expanding economy in 2017. Ironically, in March of 2020, just as the world went into a pandemic, it went to value regime, and then went just back to growth regime a couple of months ago. So in regime world, this is an exciting time for us, okay? We're just switching regimes just recently. So on the next slide, this is sort of really just an illustration of the importance of that. So why does it matter? In 2021, the market's up 26%, but we're long cheap value stocks and short expensive ones. So we outperformed the market. Last year, the market's down a lot, but again, we're long the cheap stocks, short the expensive ones, so we can be up in a down market. So it's the closest we'll come to a marketing side. There's other people doing regimes, and we'll come back to why, if we have time, a couple of slides on why sometimes people got this most recent switch wrong, but it was really they understated the importance of the consumer. The consumer, both from a balance sheet and a cash flow statement, is much better off than in most recessions. So there you have it.
The panel, and thank you, Kevin, for kicking that off.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.